Building a stock portfolio is one of the most effective ways to grow your wealth over time. But where do you start? Whether you're a complete beginner or have some experience in investing, creating a well-balanced portfolio is essential to minimizing risk and maximizing returns. In this video, we'll take you through the step-by-step process of building your stock portfolio from scratch. You'll learn how to choose the right stocks, diversify your investments, and make smart decisions that align with your financial goals. Let's dive in and get you on the path to becoming a confident stock investor. Today, we will talk about how to build a stock portfolio step by step. So before we get started, make sure to hit that like button, also subscribe to my channel. Building a stock portfolio may seem like a daunting task, especially if you're just starting out, but it doesn't have to be complicated. The right approach, combined with patience and a little research, can help you create a portfolio that aligns with your financial goals and risk tolerance. In this video, we'll walk you through the essential steps to build a successful stock portfolio from scratch. Stick around till the end for some key tips on how to make your portfolio work for you in the long term. 10. Set clear financial goals. The first step in building a stock portfolio is to set clear, realistic financial goals. Are you investing for retirement, a down payment on a house, or simply to grow your wealth over time? Knowing your objectives will guide your investment decisions. If your goal is to save for retirement, you might want to focus on long-term growth and income-generating assets like dividend-paying stocks. On the other hand, if you're saving for a short-term goal, you might need to adopt a more conservative approach. 9. Understand your risk tolerance. Your risk tolerance is how much risk you're willing to take with your investments. Some people are comfortable with high-risk, high-reward investments, while others prefer safer, more stable options. To assess your risk tolerance, ask yourself how you would react if the value of your investments dropped by 10% or more. Would you panic, or would you be able to stick with your strategy? 8. Choose the right investment accounts. Before you start buying stocks, you'll need to decide where to hold your investments. The most common options are brokerage accounts, retirement accounts like an IRA or 401, and tax-advantaged accounts like Roth IRAs. If you're just starting out, a regular brokerage account is a good place to begin because it's easy to open and doesn't come with restrictions on when or how you can withdraw funds. 7. Diversify your portfolio. One of the most important principles of investing is diversification. It means spreading your investments across different sectors, industries, and even geographic regions. The idea is simple. If one investment drops in value, others might rise, balancing out your overall risk. To diversify effectively, you should include a mix of stocks, bonds, and other asset classes in your portfolio. You can also consider adding international stocks or investing in ETFs and mutual funds that give you exposure to a wide range of companies. 6. Start with blue-chip stocks. If you're new to investing, starting with blue-chip stocks can be a good idea. These are well-established, financially stable companies that are leaders in their industries, such as Apple, Microsoft, or Johnson & Johnson. Blue-chip stocks tend to have a history of strong performance, regular dividends, and relatively low risk compared to smaller, newer companies. These stocks are often less volatile, making them a great foundation for a beginner's portfolio. However, remember that even blue-chip stocks can fluctuate in value, so it's important to continue diversifying your investments to balance out any risks. 5. Consider exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are another great option for beginner investors. These funds pool money from many investors to buy a basket of stocks or other assets, providing immediate diversification. ETFs are traded on the stock market just like individual stocks, but they give you exposure to a wide variety of companies within a specific sector or even the whole market. For example, an ETF might track the S&P 500, which includes 500 of the largest companies in the US. By investing in an ETF, you're essentially buying small portions of each of those 500 companies. This helps you spread out your investment risk while still participating in the overall market's performance. ETFs are an excellent choice for those who want to keep things simple while still building a diversified portfolio. 4. Don't forget bonds and fixed income investments. While stocks are the main focus of most stock portfolios, it's also important to include bonds and other fixed income investments. Bonds are essentially loans you give to companies or governments in exchange for interest payments over time. While they usually offer lower returns than stocks, they also carry less risk. By including bonds in your portfolio, you can add an extra layer of safety, especially if you're looking to reduce your overall risk exposure. A typical beginner portfolio might include a mix of 70% stocks and 30% bonds, but the exact ratio will depend on your personal risk tolerance and financial goals. 3. Set a budget and stick to it. Before you start investing, it's essential to set a budget. Determine how much money you're willing to invest and make sure it's an amount you can afford to lose. Remember, investing in the stock market is a long-term game, and while you might see some short-term gains, there are no guarantees. Sticking to your budget ensures that you are not overextending yourself and that your investments won't interfere with your other financial goals. Additionally, make regular contributions to your portfolio over time, whether it's weekly, monthly, or annually. Consistency is key to building wealth in the stock market. 2. Monitor and rebalance your portfolio. Once you've built your portfolio, it's important to keep an eye on it and rebalance it periodically. As the market moves, some investments may grow faster than others, causing your portfolio to become unbalanced. For example, if stocks have performed really well, they might make up a larger portion of your portfolio than you intended, increasing your risk exposure. Rebalancing your portfolio involves selling some of your higher-performing assets and buying more of those that have underperformed. This helps ensure that your portfolio remains aligned with your goals and risk tolerance over time. Many investors choose to rebalance their portfolios once a year or whenever their portfolio allocation shifts by a certain percentage. 1. Stay patient and keep learning. The most important aspect of building a successful stock portfolio is patience. Stock prices can fluctuate, and you might feel tempted to sell when the market dips. However, staying invested and sticking to your long-term strategy is often the best way to build wealth. The stock market rewards patience, and over time, your investments will likely grow. Also, keep learning. The more you understand about the market, the better you'll be at making smart decisions with your money. Building a stock portfolio doesn't have to be intimidating. By setting clear goals, understanding your risk tolerance, and diversifying your investments, you can start creating a portfolio that works for you. Stick to your plan, stay patient, and watch as your money grows over time. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.